Have you ever wondered about the secrets behind successful investment strategies? Ever thought about how the Oracle of Omaha, Warren Buffett, made his billions? Well, you're not alone. Many have sought to decode the wisdom of this investment titan. With a net worth of over $80 billion, Buffett is a living testament to the power of smart, strategic investing. His principles have stood the test of time, guiding countless investors through the complex world of finance. As we stand in the year 2024, his advice remains as relevant as ever. From maintaining a long-term perspective to understanding the businesses you invest in, from recognizing the importance of economic moats to the art of value investing, Buffett's wisdom is a beacon for those navigating the financial seas. So buckle up! Greetings to Future Minute. Kindly consider subscribing to help my channel flourish. Your support holds significant value, and I appreciate every subscribe. Join us as we delve into the wisdom of Warren Buffett and his timeless investment advice. First on our list, thinking like a business owner, not a stock trader. This perspective, a cornerstone of Warren Buffett's approach, encourages investors to view their investments as owning a piece of a business, not just buying a piece of paper. It's about adopting a long-term mindset. Buffett himself has held shares in companies like Coca-Cola and American Express for decades. Why? Because he believes in their business models, their management, and their potential for growth over time. This isn't about quick wins or short-term gains, it's about patience and persistence. It's about understanding that the real value of an investment comes from its ability to generate profits over the long run. It's about recognizing that the stock market is unpredictable in the short term, but over the long term, solid businesses with strong fundamentals tend to rise. Remember, investing is a marathon, not a sprint. Buffett's second advice: stick to your circle of competence. Warren Buffett, the Oracle of Omaha, has always been a proponent of investing in sectors and industries that you fully comprehend. There's an elegance to this approach, a simplicity that can be both comforting and empowering. Imagine you're a tech enthusiast. You understand how algorithms work, what makes a gadget groundbreaking, and the impact of AI on our future. It would make sense for you to invest in a tech company, right? That's because you understand the business, its potential growth, and the challenges it may face. Buffett himself is a prime example of this principle. He avoided tech stocks during the dot-com boom because he didn't understand them. And when everyone else was left picking up the pieces after the bubble burst, he was unscathed. So remember, don't let FOMO drive your investment decisions. Stick to what you know. When it comes to investing, knowledge truly is power. Next up, two key principles: economic moats and value investing. Let's decode these terms. An economic moat is essentially a sustainable competitive advantage that a company enjoys, shielding it from rivals. Think of it as a medieval moat, protecting a castle from invaders. This could be a strong brand, proprietary technology, or even a dominant market position. Warren Buffett is drawn to such companies because their moats allow them to generate stable long-term profits. They're like golden geese, laying one golden egg after another, unhindered by competition. Then we have value investing, the art of buying stocks for less than their intrinsic value. It's akin to finding diamonds in the rough, companies that are undervalued by the market but have strong fundamentals. For Buffett, the allure of a bargain is irresistible, but it must always be a bargain tied to robust quality. In the words of Buffett, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett's next pieces of advice revolve around the management and finances of a company. Imagine investing in a company as boarding a ship. The management team serves as the captain and crew. Their competence and integrity steer the direction of the ship, impacting its destiny. Buffett's investment in Geico, for example, was not only based on its strong business model, but also on his trust in the management's capabilities. Now let's dive into conservative financing. Buffett advocates for companies that avoid excessive debt and maintain a strong cash flow. It's like preferring a ship with a well-maintained hull over a flashy one riddled with hidden leaks. Buffett's investment in the Washington Post demonstrated this principle, as the company had little debt and a strong cash position. In essence, the character and competence of a company's leadership, coupled with conservative financial practices, are vital considerations. Investing in a company is like marrying into a family. The character and competence of the leadership matters. Next, let's talk about market fluctuations and diversification. Warren Buffett encourages investors to view market fluctuations as opportunities, not reasons to panic. In the world of investing, volatility is inevitable. Instead of fretting over short-term market movements, see them as potential entry points for sound investments. Now, onto diversification. Buffett famously said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." While it's important to spread your investments for risk management, over-diversification may lead to a lack of focus and understanding of your holdings. Aim for a balance, diversify your portfolio, but not to the extent that you lose track of what you own. The key takeaway here is to remain patient and informed. Don't let short-term market swings sway your decisions. Instead, focus on the long-term potential of your investments. Remember, the stock market is a device for transferring money from the impatient to the patient. Buffett's next advice involves understanding risks and the importance of cash reserves. Investing is not just about the potential for high returns. It's also about acknowledging the inherent risks. Understanding these risks, the possible pitfalls, and how they can impact your investments is crucial for making informed decisions. It's about not just knowing the sunny side of the street, but also the dark alleys. Moreover, Warren Buffett emphasizes the need for keeping cash reserves. But why? Well, having liquidity or cash on hand allows you to seize attractive investment opportunities as they arise. It's like having an umbrella ready for when it starts to rain. It also serves as a safety net, a margin of safety, if you will, cushioning you against unforeseen financial downturns. So remember, while investing can be a path to wealth, being aware of the risks and maintaining some cash reserves can help ensure that journey is a steady and secure one. In the world of investing, the first rule is never to lose money, and the second rule is never to forget the first rule. Last but not least, Buffett emphasizes the importance of continuous learning. Imagine the financial market as an ever-evolving ecosystem. It's dynamic, complex, and constantly changing. To navigate this labyrinth, one must be armed with knowledge and the thirst to keep learning. The investment world doesn't stand still. New financial instruments, emerging markets, regulatory changes, and economic shifts are all part of this intricate dance. To stay ahead, Buffett encourages investors to be perpetual students of the market. Understanding the nuances of your investments, staying informed about current events, and continuously learning about new investment strategies can give you an edge. Remember, knowledge is not just power. It's a key asset for successful investing. But don't just take our word for it. Buffett, one of the most successful investors of our time, has been an avid reader and a lifelong learner. He believes that the wisdom gained from this continuous learning is a significant contributor to his investment success. As Buffett says, the more you learn, the more you earn. So there you have it, Warren Buffett's 11 timeless advice for investors. We've journeyed from understanding the importance of long-term perspectives, recognizing the value of investing in businesses you understand, and the power of economic moats. We've delved into the principles of value investing, underscored the importance of quality management, and conservative financing. We've navigated through the choppy waters of market fluctuations, emphasizing the need to view them as opportunities rather than reasons to panic. We've highlighted the significance of diversification, but not at the expense of a thorough understanding of your holdings. We've stepped into the shoes of the cautious, understanding the risks associated with investments and the importance of keeping cash reserves for those unexpected opportunities. Lastly, we've acknowledged the essentiality of continuous learning in the world of investments and financial markets. Remember, investing is a journey of lifelong learning and patience. Happy investing!